Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with Enrique Abeyta of HX Research. Enrique has a long career as a successful hedge fund manager and a newsletter writer. He's a phenomenal researcher, stock picker, and analyst. And he's here to talk to us today about Talon Energy. Ticker is TLN. This is not financial advice. You guys should do your own work before investing. You know all the legal restrictions and boilerplate. Enrique came on to talk to us about Talon Energy May 24th of this year. At the time, Talon was trading at 112. Since then, the stock is up 82%. So that's an 82% return in the less than 6 months since he presented the idea to us. In addition to that, there was an adverse regulatory decision made after the close on Friday. Over the weekend, the stock was indicated down. I had the opportunity to read Enrique's research over the weekend and speak to him. As a result of that, I was buying Talon Energy myself in the pre-market on Monday, just 3 days ago, at 152.80. The stock is up 33.5% since then. So because we had the chance to talk to Enrique and he was kind enough to allow us to use his research on the Deep Knowledge Investing website, there was the opportunity to earn another 33, 34% just this week alone. Now, Enrique, I want to go to you. First question, and feel free to introduce yourself and talk about yourself. But my first question to you is going to be, we've made great returns in Talon Energy, but we didn't get the best returns. Where was the stock price when you originally recommended it, when you bought it for yourself?
We recommended it as so we launched my new research service, HX Research, which you can find us at daily.hxresearch.net on February 1st. And we had 3 or 4 initial recommendations. And Talon was our first idea that we introduced. And I believe it was on, I'm going to look it up here. It was on February 16th. I'm pulling up the tape here. February 16th at $67.63. So as of today, any of our paid readers who bought the stock on our initial recommendation are up just shy of 200% on the idea in a little bit, 8-9 months, something like that.
That's you can stay in business with returns like that.
You don't need very many of those to make it a good year. How about that?
Yeah, exactly. So I think the thing that we should be focused on for today primarily is going to be the adverse regulatory ruling and the way you correctly said, hey, people are interpreting this wrong. This is not a bad thing. But for people who haven't taken the opportunity to watch the original video, and just so you know, it is up on YouTube. It's on the Deep Knowledge Investing channel. We've got Enrique's the whole video that was done. But why don't you take a few minutes and talk about the company, the assets they own,
Okay.
and what you think the pieces are worth here? Because I think your sum of the parts analysis is really interesting.
Yeah, look, I'll try to make this as simple as I can. Relatively complex story. Talon, ticker TLN, is an independent power producer. I'm going to say a couple things for some of you that are knowledgeable. Some of the things I say will seem redundant, but I think there's a lot of people that are involved in these stocks that don't know these industries. Independent power producer does not mean not regulated. They are highly regulated. It means that they can sell their power in the open market. The company was created maybe 8-9 years ago when PPL, the old Pennsylvania Power and Light, combined their generation assets with the generation assets of a private equity firm. And this is going to be salient for later. Those of you who aren't as familiar with the electric utility business, there's really 3 parts of the ecosystem: generation, power plants where we make the power; transmission, big pipes that take the power from the plant to the curb; and distribution. That's when the power goes to your house. Okay. And so what Talon was and is they own generation assets. They don't own any pipes. Okay. So the company was put together in the late 2010s. I'm not sure what we're supposed to call those. And, was the private equity guys ended up actually taking it private, layering a bunch of debt on it. And so essentially they had a portfolio of power generation. They had contracts as well as power that was floating, and they put a bunch of debt on it. Well, in the late 2010s, we had too much power. We had a surplus of power in this country that was then exacerbated with COVID, believe it or not. And so what happened is that whole thing flipped over. The company, there was nothing wrong with their power generation. The company was profitable. They just had more debt than they did profitability to service the debt. So the company went bankrupt in 21, 22, and then emerged from bankruptcy in 2023. Okay. When we initiated on the stock, it was traded in the pink sheet, so over the counter. It was still cleaning up its balance sheet. They had many different assets. They had a portion of a lawsuit with PPL. They had generation in multiple markets, all these different things, and a bunch of other things that they still needed to clean up. And what we thought the opportunity was, and we've done utilities for 30 years, it's been one of my best returning areas, is we said, look, fundamentally, there are two really interesting aspects to this company. The first is if we just look at the assets they owned and we went out and tried to build those assets today, and we're going to come back to this company, it would cost 20 to 25 billion to build these assets. At the time, the enterprise value of the stock was like 3.5, 4 billion, something like that, maybe 5. That was number one. Number two, we said, if we look at the earnings potential and power for this company, we think that we might be buying in at 3, 4, 5 times EV to EBITDA. Really well-run IPPs were trading at the time at about 15, okay? And so that's when we put in 67, 63, on February 16th of this year. What happened very quickly was Amazon came out and announced a deal that they were going to buy a data center that Talon had built right next to their biggest asset, which is a nuclear plant called Susquehanna. So we're going to come back to that, but let's take a step back and talk about what Talon was and what it is. When we bought it, it was all this generation lawsuit, all this other stuff. They own this data center that they had built right next to their nuke. Today, Talon is a very simple company. They own generation in one market, which is called PJM. That's about 15 states. It's 85 million people. And that generation portfolio is led by this nuclear asset called Susquehanna, which was brought online in the early 1980s. It's about 2.3 gigawatts of nuclear power. It's the 6th largest nuke in the country, has an exceptional track record. So they own this big nuke, a bunch of gas, and a little bit of coal. And the whole portfolio, I want to say off the top of my head, is about 10, 11 gigawatts. And so what the deal they announced was as follows. So but let me again go back to the original move in the stock. We thought the stock would go from 65 to 150 to 200 just because the assets were worth much more. By the way, when I quote the value replacement value of 20 billion, if you look at Southern and Company just opened a new nuke. That nuke is about the same size as Susquehanna. That nuke cost them $20 billion in a decade to make. If you looked at the enterprise value of Talon today, and the stock keeps moving here, so I gotta literally look it up. The enterprise value of Talon today is probably about 13, 14 billion. So, our first idea was to build this nuke. A new one would cost 20 billion. We were paying 4 or 5 for it back then. Now you're paying 13. You're still at a big discount. And the stock has begun to close some of that fundamental discount. But something else happened that we kind of thought would happen, but never could anticipate to this level. And that is AI, data centers, hyperscalers, et cetera. We were a fan. We knew about it. But remember, this is back in late 23, early 24. It really obviously accelerated this year, the spend. I mean, go look at the chart of NVIDIA, and that'll tell you how much it accelerated. And so what's happened for all of the IPPs is in this country, we're on the precipice of a huge power crisis, okay? And it's very, very simple. Demand was growing 50 basis points to 150 basis points. And now it's going to grow 2, 3, 4% because of EV, because of hyperscalers, because of reshoring manufacturing, which is only going to increase with Trump. In the meantime, because of NIMBY, not in my backyard, the green movement, shutting down nukes, et cetera, we've had very minimal supply growth. So what that means is if you own independent supply, so again, highly regulated, but independent to trade, you have a positive exposure to higher power prices. And what I'm going to tell you, power prices are going up potentially by a great deal. So let's get back to, I'll kind of finish up here and then we can go to the regulatory thing. Our idea was you're coming out of a bankruptcy. It's a good asset. They're going to clean it up. They're going to do the right thing. The thing's worth $20 billion on the assets, probably worth $20 billion on just trading. We were paying $5 billion. What happened? They cleaned everything up. They brought it all back down. And then they signed this deal with Amazon where they sold that data center business and contracted at power prices that were, for that piece, at a 50% premium to what was getting paid at the time. And so what happened is the earnings model, that idea that they could earn, whatever, $1 billion and a half, began cemented in the mind of the market. So that's sort of the journey that we've had with the stock. And that kind of takes us up to Friday's regulatory decision.
Sounds good. So hang on, before we move on to
Yep.
Friday's regulatory decision, you talked about buying these assets for about $4 or $5 billion when the nuclear plant you thought was worth maybe 25 or so, give or take a bit. And now you're saying, hey, the company's trading at an EV of about $12, $13 billion.
Yep.
So you're already in a situation where your readers have made 200% or so on the stock, almost that. DKI subscribers have made almost 100% on that stock this year and, made over 30% just this week alone. What is your target price on this? When you add it all up, what do you like? Would you be buying the stock here? What do you think the whole company is worth?
Look, we would be. I mean, let me just take you through, because I was pulling my model as we went through it. Let me just give you fresh numbers. So with the stock at the 51 million shares outstanding, with the stock at 202, that's a $10.3 billion market cap. At year end, they're going to have 1.88 billion of net debt. That puts the enterprise value at 12.1. We believe that on a normalized EBITDA, okay, they can be doing 1.35 billion of EBITDA, and we can go through that and all of that, and that puts it at a current multiple of about 9 times. We put a target of 12 times on it, just so you know, and this company trades at a big premium. Constellation, which is the largest nuke holder in the country, trades on an EV to EBITDA on a forward basis at 17 times. So I don't think 12 is outrageous. And if you put a 12 times EV to EBITDA on it, subtract out the debt, you get a target price of $280 or plus 40% from here. I'm going to throw a couple of things out there. That's to start. Do we think that EBITDA could be 1.5 or higher? Absolutely. By the way, that target equity value puts the company still at only about a $14 billion market cap, $16 billion enterprise value. My honest belief is that Talon will not be a publicly traded company a year to 18 months from now. And someone, Constellation, Vistra, NRG, PSE&G, or Amazon, Microsoft, someone else is going to do the math and say, well, if I wanted to build a nuke, it would cost me $20 billion. I can buy this thing for $20 billion and I get a nuke today, tomorrow, time value of money. And I think that that's not a terrible price target. So let's take 20 billion. So it's 18 billion. If I subtract out the 2 billion of debt divided by 51, that would be $350 a share. So I think 280 to 350 is a reasonable price target.
Wait 1 second. So the 350, you think that's the takeout price? What multiple EBITDA do you think they get on a takeout?
So, I mean, the 350, if we did that, that would be 21.35. That would be 14.8 times. So, okay. Give you an example. Constellation goes out and pays stock tomorrow, pays stock at 350. Constellation stock is, let's say that the stock will go down, but that's right. So let's say the stock traded down 10% on Constellation. It would still be accretive on the multiple. The other thing is Constellation actually owns a nuke that is the exact same set up same generation, et cetera, about 200-300 miles up the river from or upstate from where Susquehanna is. So they could pay 350 and it would still be, I haven't run the accretion numbers because a lot of assumptions, it would still be very, very nicely accretive. So, I'll say this. Look, the stock's had a good run. I think it's got a very nice run in front of it. Is it going to be up 300-400% from here, which is where I think we end up from our original investment? No, but I think you've got 50 to 100% upside from these levels.
Yeah, and missing 50 to 100% upside because you missed 100% upside before, or 200% upside, that's foolish. It doesn't matter what yesterday's.
Remember, a stock to go up 400 or 500% has to go up 100 and 200% first. There's never been a single stock that's been a 5-bagger that wasn't a 2 or 3-bagger to start.
That's right. Exactly. So you're talking about potential acquisitions by other power companies and other IPPs. Could Amazon bid on this? They certainly would want the power, they would want the asset, but do they want to operate a nuclear plant? That's complicated, not impossible. They could hire someone to do it, but
I don't think that's the issue. I mean, they don't need to hire someone. They could just buy Talon and use the management that's there. Does Amazon want to operate a UPS FedEx? Does Amazon want to operate giant 3PL? Does Amazon want to operate data centers? I could have said any of those things to you 10, 15 years ago, and you'd be like, no, they'll never operate a UPS FedEx. Why would they bother? They could just use UPS FedEx. Okay. Yet here we are. So I don't actually think that's the question. The salient question is, would the regulators allow Amazon to go out and acquire Talon? Now, I think a lot's changed in the last 3 days, and it's not so much that I think that the Trump administration is going to be such huge friends of big technology or anything like that. But I do think they'd be more open-minded to it. And I think we could see a number of deals. What if Amazon goes in and says, okay, we're going to make a commitment to add, via SMRs and small modular reactors and a whole bunch of stuff, 3 gigawatts to the market through gas, all these other things, and let us buy this and all that. I think that there's a potential to get a deal done. But again, I'm not telling you Amazon's going to buy the company. I'm just telling you we got a lot of nice optionality. And let me make an important point here, okay? Because whenever you're looking at a stock, you've got to look at potential return, probability, and what I'll call visibility. What's so awesome about Talon here, we certainly have a pretty attractive potential return. I'm going to tell you, we've got very high probability and we've got incredible visibility. So, it's just like when you look at NVIDIA, like I think NVIDIA is great, probably goes higher, all that. But NVIDIA's earnings could get cut in half. If it goes Cisco 2000, 2001, that would be very normal. That's going to be very difficult to happen here. You've got a different kind of visibility in a very long cycle, capital intensive business. So, I think it's possible that Amazon, Microsoft buys one of these. Is it probable? I don't know. I kind of don't care.
All right. So let's talk about Friday's ruling. I believe it was issued after the market closed on Friday. And so what we saw immediately was the stock was down, I think, 10% in the aftermarket. And there was a whole weekend of confusion on it. What was the ruling and why were people initially concerned?
Okay. So let's go through. When I talked earlier, I very specifically went through this idea, a very simple framework of generation, where we make the power, transmission, big pipes, distribution, little pipes. So the data center that Talon originally built, which is called Cumulus Data, was done with a behind the meter deal. What does behind the meter mean? Well, what it means is that their nuke is here. They built the data center here. As a result, they didn't have to pay a third party to build a pipe between the nuke and the data center. So they don't need to pay AEP or Exelon or PPL or anyone. They just built the darn pipe themselves. It literally goes across the parking lot. I can show you the picture. It's literally goes underneath the parking lot, but they built the pipe themselves. So as a result, when you look at, for instance, in PJM, transmission costs are usually about 15 to 20% of the landed cost of power. So when they built the data center, this is the original 300 megawatt facility, what they did is they were able to get power at a 15 to 20% discount. Now, when Amazon bought the facility, which is 300 megawatts of power consumption today, has the ability to ramp up to 960 or 980 megawatts. I don't remember what it is. Amazon and Talon. So one thing quick here. When the deal was announced in March, it was closed in March. The deal was closed. It didn't need anyone's approval. Amazon has owned this thing since March. There was a lot of stuff on CNBC. People were like, oh, the regulators denied the approval of the Amazon deal. Deal was already approved. Right. What happened was Amazon came in and said, okay, we're at 300 megawatts today. We want to go to 480. And we want that incremental 180 to also be behind the meter so we get this 15-20% discount. Now, when they announced that, this is a whole set off a whole bunch of shockwaves. What happened is you had two regulated large transmission distribution companies, AEP and Exelon. They came in and said, well, this is not fair. And the reason they said it's not fair is they said, well, when we built our transmission, the big pipes, we did it based on the idea that there would be a set amount of generation to go into it. And by the way, in this is the random that these numbers work out this way. In PJM, there's 180 gigawatts of transmission, of generation. This happens to be a request for 180 megawatts, so 0.1% out of that. So what they were saying is that when we build our transmission and we're looking to get our money back, we did it on the idea that the denominator was going to be 180 gigawatts. Well, now you're going to reduce the denominator, and in doing so, you increase the price to the consumer. Amazon saves that 15-20% on the 180 megawatts, but every other consumer in PJM is going to have to pay a little bit more because we reduced the denominator by that amount, okay? And they're not wrong. That is correct math, and that is the way the system works. What comes into account, though, I'll say two things. Number one, it's materiality. Amazon, the 180 megawatts is 0.1% of capacity. AEP and Exelon claimed it would be 140 million, but we actually backed into it in our most recent report, the one that you published also. We backed into how much is spent on transmission and distribution. It's hard to get to that number. So this number really didn't matter, but we're going to come back to that in a second. The other thing, so they said prices will go up, okay? In theory, they're right. Prices would go up. The second thing they said is that reliability would go down. We had 180 gigawatts out in the market. Now we got 180 minus 180 megawatts. Okay, that's also theoretically true. It doesn't really matter. It's 180 megawatts. And regardless of whether Amazon was in front of the meter or behind the meter, when we add that much incremental demand, reliability goes down to a certain extent anyways. So the FERC came out and said, I'm sure they sat there and they said this. They go, well, it's not really going to move prices. And it's not really going to change reliability. But that's not our problem. It's not the Talon Amazon deal. Our problem is, what if there's 30 more of these deals? And if instead of moving 180 megawatts of 180 gigawatts, what if it's 15 gigawatts? Now we're talking about 10% of the market. So we don't want to set a precedent that we're going to allow these deals and not the recoupment of the transmission and some pulling stuff off of the grid with this single deal and open the floodgates for a huge amount. So they basically said, no, we're not going to approve this. Okay, it was shot down it was actually shot down 2-1 in a 5-person commission, which is interesting because, again, I think they were in this quirky spot that they're like, yeah, it's really not a big deal, but we don't want to set the precedent. So what does that mean? We came out, first off, no one was putting any of these there. Everyone was saying, oh, they didn't approve the deal. No one had any of the numbers. Like, it was effing ridiculous, to be honest. But
how are these people reporting on this? They're going on TV and in the newspapers without understanding the situation.
So politics, economy, whatever. It's pretty much how it works. But that's what our job is, right?
I knew the answer. I just want to see if I could ask that one with a straight face.
So let's just get to what happens here. And look, the stock obviously agrees with us. This is what's going to happen is, Amazon will come in and say, okay, well, we can't go behind the meter. You're telling us we can't. So we'll just go in front of the meter. We'll take that 15% that is paid into the pool and we'll go ahead and pay it.
When they say that, you mean pay the transmission costs on it.
Correct.
So that retail customers of that power transmission company will not end up bearing any extra infrastructure because of that. All they're doing
Correct.
is on that 15%, they would pay, sorry, on that 180 megawatts, they would pay the transmission costs in addition to what they already agreed to.
Exactly. And to put that into
is how much money?
context, well, so put that into context. When Constellation announced the deal with Microsoft to restart the dormant reactor at 3 Mile Island, the numbers I've seen is that it's roughly a little bit more than $100 a megawatt hour. The numbers we had read about Amazon is that they were going to pay $75 a megawatt hour. If I take the PJM transmission numbers, which I have, which are on average are 15%, I take 75 times 1.15, I get 86.25. We're still at a discount of 15% to the number that Microsoft is paying for 3 Mile Island. By the way, my understanding is that the 3 Mile Island deal with Constellation has elements that were in front of the meter, which again, these are really just throwing the other utilities a bone, because 3 Mile Island doesn't use any transmission and that reactor's been shut down for the better part of a decade. So there really isn't any cost that they're taking on. So what's going to happen? I think they're going to refile the expansion. That expansion is going to come with them paying more. And then what they'll do in regards to reliability, they'll basically just put stuff in place. There's a half a dozen solutions they can put on that, are batteries, just different things that kind of address this concept that by pulling this power out. But I get back to one important thing. If Amazon just went out and bought the power in the open market, but they needed 180 incremental megawatts, it still pulls 180 megawatts out of the grid. This is coming, and this is the part that's important here, and why the stocks are still went up. You can't play chicken with capitalism. Okay, there was a point in California where prices went up, and California said we're just not going to pay the prices to the utilities, and California ended up having to give in to that because it just doesn't work. There is supply, there is demand. You have to fulfill that, and these utilities. So this is just economics. What I think happens here, I'm going to give one big but at the end here. What I think happens, they refile the ISA, the amendment, sometime in the next 3 to 6 months. They agree to play the transmission. They agree to do a couple other things on reliability. And the FERC, which is in a rules making right now, says, okay, we'll agree to this. This is a good precedent that you're agreeing to pay the transmission and put in some degree of increased reliability, and we'll go ahead. Amazon, meanwhile, is looking as well as we're still getting at a 15% discount to Microsoft. They don't care. It means nothing to them. So, and I would argue there's an argument where Talon gets better economics. So this is exactly what's happened with the stock. You bought it at 150. Today the stock hit a high of 205. I think that on Monday, people started figuring this out because they were reading me and some of the other smart analysts that were out there. And then now, with the Trump administration coming in, the idea that you could see additional consolidation, to see more of these deals has put a further bid underneath the stock. My one big proviso, though, okay, Talon is not NVIDIA or Microsoft or Meta. The stock's not going to 1,000. And here's the reason why. Ultimately, the government will step in once prices are too high. How does the government step in? Even on completely, independent businesses, they will put in some degree of regulation. So what I think happens here is there's a cap on these stocks. Like, they're not going to infinity. They're not going to earn, infinite, because ultimately we're not going to have ratepayers in Pennsylvania paying 5 times the amount they're paying today. I think we've got plenty of runway until we start getting it. It's kind of a rich person problem to have. Like, I think prices would have to double from here to be in that issue. And if prices double from here, Talon ain't earning 1.35 billion. Talon's earning, 2 billion, 3 billion, something like that. So there is a cap, but this is where we're trying to think one step ahead, or maybe 10 steps ahead, as the case might be.
Okay. So you're right. The amount of extra money it would take Amazon to pay the extra transmission cost, that 15% on the excess 180 megawatts, it's meaningless to Amazon. But assuming that they just make a principled stand, does Talon have any responsibility to work with Amazon and say, okay, all right, you guys pay this, but, we'll reduce your contractual cost to us by a certain amount? Does Talon have any responsibility to soften the blow to Amazon?
No, but I'm sure they talked about this before. Like, I mean, I'll tell you this: there was a statement that came out from Amazon on Monday, said we are 1,000% committed to this deal, and that's actually when you look at the stock, why it rallied so much. I'm just pulling up the 5-day intraday here. You know why it rallied so much the next day was exactly that. Is that Amazon came out? It means nothing to them. It's more important that they have a great relationship with them and all that. And again, forest through the trees. What the forest is here is we don't have enough power, and power prices are going up, and we're not going to be able to build the power quick enough to keep the power prices from going up. These guys own a bunch of power that will get those higher prices. That's the story. That's the story. Nothing here changes that story in any way, shape, or form. So
Enrique, what you're talking about actually is deep knowledge investing's exact thesis on nuclear energy and uranium. It's simply that you have a current supply and demand imbalance. There is less supply than there's demand. The uranium stockpiles are coming down every year, and the new demand that's being built will come online before the new supply that's being built. It's the same thing here.
It is the difference. The only difference I'll say is it's a lot easier to get more uranium than it is to get more nukes.
Right.
It doesn't cost 20 billion and take a decade to build and a bunch of regulatory, in commodities. And I'm constructive on uranium. High prices solve high prices in commodities throughout all time. I've been saying this about gold. Is like, gold goes to 5,000. There's going to be a lot more gold out there because I guarantee you there's more gold in the crust of this planet. This is my gold versus Bitcoin comparison is that, if Bitcoin goes to 500,000, we're not making more Bitcoin. But if gold goes to 5,000, we're making a hell of a lot more gold. So the same thing's true for uranium. But yes, I'm constructive on uranium for similar reasons.
But I will point out that Cameco has been operating some of their contracts at a loss by buying supply in the spot market instead of mining more. They're underproducing and have been for years because Autoprom can't get enough sulfuric acid to produce. They actually just lowered their supply estimates.
What I would say, getting back to return probability and visibility, I think the uranium story is a good one. I think this is a hell of a lot better one.
Fair enough. All right. So what do you think happens in the power generation space? That we need to be building more power generation and more transmission. What do you think happens? And does Talon Energy have any plans to participate in that? Or do you think they're just going to operate the existing assets and maximize what they have?
Yeah, look, I do think there is an emerging bipartisan consensus that they understand we need more power generation and more transmission. I think that nuke has become viable for both parties, which wasn't true for the Green Movement of the Democratic Party until the last 5 years. I think that the best place to build more nuke is where you've got nuke already. And so I think that what we're going to begin to see, whether it's SMR or whether it's full reactors, is people who own nuclear generation are going to have the ability to expand that nuclear generation. That's going to be the best and easiest place to do it. Okay. Now, off the top of my head, Susquehanna. So Talon, by the way, had actually sourced another site to build another nuclear reactor, which they filed for 10, 12 years ago. They just bought the land. They never ended up doing anything else. I haven't gone down the road of going through and saying, okay, how much more nuclear capacity could they put on to the Susquehanna site? Can they get this other site, et cetera? But I know what's factual. It's easier to put nuke where nuke is, and it's easier to have someone build nuke who's already running nuke. Those are just, that's just facts. And so I think that's upside optionality. And I got to be honest with you, a Trump presidency with a red wave means it's a lot more likely we're going to see nuke and we're going to see more transmission. Now, by the way, it also means a lot more likely we're going to see a bunch more gas. And so what would be the bear cases here? Well, if we have a wave of CGT, quick fire gas comes on, that'll take some of the cream off of the cup or the pie for the prices of power, and it'll impact the nuke situation. The other thing is, like I said, at some point, if prices go too high, that the regulators will step in, and I think Trump will be a proactive regulator in that because he legitimately cares about the consumer. And so, I think that caps it. But I don't know. I get to 350 without worrying about any of that. So, don't let me. I'm not going to worry about 400 to 600 when I'm trading at 200. So I think those are real issues. But look, I think I even put this. Did I put this on Twitter, X Twitter? You can follow me, Enrique Abeyta. I think I said that I think Talon will be 250 by the 1 year anniversary of our recommendation, which was February 16th. So, I think that there's nothing really stopping it for, in the next year, 6 months.
Yeah, outstanding. And I really think your analysis of the political realities of this are interesting. Certainly the Republicans are going to be in favor of this, but the truth is that a lot of the things that Democrats tend to like EVs, we need more power generation. Every time you add an EV, it's like a couple dozen. It would be like if in your home you added a couple dozen refrigerators. That's a lot of additional demand.
And nuke wins now because, look at this. Yeah. Like we know Trump's going to be unfriendly towards wind and solar, unfriendly-ish. We know the Dems are inherently unfriendly towards gas. Both of them are friendly towards nuke. Who's got the best chance to build more nuke? People who operate nuke. That's it. That's real politic. Does that mean that we don't see maybe Trump actually expands wind and solar, which may or may not help. Maybe we get a ton of CCGT done. Maybe. But what I know is they both agree on nuke, and people who have nukes are best off to build more nukes. And so, but let me tell you the magic. Let me give you the one last piece of magic to this equation. And this is when we talk about visibility. So what Vistra has done, which is the old Texas utilities, Vistra has gone out and taken their balance sheet. I'm pulling this up here in my Bloomberg. Vistra's gone out and taken their balance sheet and bought the hell out of the stock. Vistra in 2018 had 505 million diluted shares outstanding. Today, they have 348 million. So they bought 30% of the stock in the last 4 years. Vistra, in the last few quarters, let me just do this. I'm pulling up here 1, 2, 3, 4, 5, 6, 7 quarters. Vistra's bought back 15% of the shares. Talon has already gone out and in this year bought back 15% of the shares. And they have enough capacity that they're under-levered. So I think Talon's going to sit there and do the following. They're going to say, this is what I would do if I was on the board. I'd say, okay, we're under-levered. We're generating a bunch of cash. That's a problem because if someone goes to buy me tomorrow, they can use my leverage against me. So what we didn't even go through is that Constellation, let's just do this. The net debt to EBITDA at Constellation is, well, it's actually pretty low. It's 1 times. Okay. These companies can go as high as 3.5, 4 times. So right now, Talon on our numbers is 1.2 times. That means they've got 2, maybe 3 turns of leverage they could use. 2.5 turns at 1.3 billion is 2.5, 1.3 times 3.25 billion. It's got a $10 billion market cap today. That's 30% of the market cap with the incremental leverage, which could be used against them in a deal. And they're going to generate 1.3 billion a year, which on the $10 billion market cap is another 13%. So give me 2 years, keep the stock price flat. We actually did this analysis, one of our reports, just for this, keep the stock price flat and go to full leverage and you buy back 50% of the stock. So, as long as they don't do something stupid, and the market kind of holds in where it is, I think they buy back 50% of the stock. And if they buy back 50% of the stock, it ain't going to be trading at 200. It's going to be trading a lot closer to our 300, 350 target.
And for the people who haven't done risk arbitrage or merger arbitrage, when you're talking about a potential acquirer using debt against Talon in a deal, what do you mean by that?
So, I don't know. I don't know the public statements from Constellation about where they said they're willing to go in terms of leverage. But I'm going to bet they're willing to go similar to what Talon said, 3.5 times. with Talon trading, with Talon's debt load right now at about 1.3 times versus their stated 3.5, or versus a Constellation stated 3.5, they could go in, an acquirer could take those 2.3 turns and basically take advantage of that financial leverage in the price. So optically, they'd be paying X, but they're actually going to reduce it by the incremental leverage that they're going to put in and improve the economic returns. Let me just give you one thing here. Constellation might have been not the right guy to look. Let's look at Vistra. Vistra operates at 3.61 times net debt to EBITDA. So Vistra is the one that could go in. Obviously they're comfortable with that. And I'm going to pull in one more here. PSE&G. I don't know what this number is going to tell me. Net debt to EBITDA. PSE&G is at 5.5 times. Okay, it's a regulated. They're more regulated utility. It's not an IPP, but they also be natural. So I tell you, I think Talon. If I'm on the board, I go to the management. I say, guys, we need to be reasonably aggressive about the buyback, because if we don't, someone's going to go in and offer to buy the company as a whole, and they're going to use that leverage that we could go in. Because I got to tell you, if we get the share price up to 250 when Constellation or PSE&G or Vistra comes in, they're going to bid 350. But if we're at 200, they're going to bid 300. That's the way this game works. Right. And so I think you're going to see a relatively accelerated. So this gets back to, again, I don't care if the stock's up 200% for our readers. The combination of visibility and probability and all these things here, like it's outstanding. It's still our best idea. Although we did just publish on Monday another idea that I think is a potential 5 to 10 bagger.
Do you want to disclose?
No, people have to subscribe. So we still got to make some money in this business.
HX Research.
Yeah, exactly.
Outstanding. The thing I like about what you're outlining here is that for this to work or work optimally, there is pressure on the Talon management team to take on more debt and buy back stock quickly, because you're right, a takeover offer will be made based off of where the current stock price is, or the then current stock price is. And, if this is the kind of thing where they think, oh, well, we've got a year to do this, you might not have a year. They might actually need to buy back that stock in the next couple of months.
And look, there's a line here, right? Like, we can't go out. I wouldn't be on the board saying, guys, we got to lever up to 3.5 times tomorrow and buy back all the stock in a tender offer. Although economically, that probabilistically is probably the right thing to do. You find this middle ground. All I'm telling you is that they're going to be highly motivated to be buying back the stock, even at these higher levels, because let's just go back to one thing. To build the damn nuke would cost $20 billion. The market cap company that's $10 billion. Buy the damn stock.
There you go. Right. And management should be doing that very quickly.
They have been, to their credit.
Fair enough. Okay. I think it's a phenomenal outline of what I consider to be the key issues. What are we missing? What else should I be asking you that I haven't?
I mean, look, what's my biggest risk with this stock? I'm more than moderately concerned about NVIDIA in the next couple of years. And it's not that I don't think NVIDIA is not a great company. It's not that I don't think NVIDIA is one of the best companies in the history of mankind. It's that I remember Internet 1.0 and the build out, and everyone was like, I can't have enough. I need infinite amount of networking equipment. I need an infinite amount of glass from Corning. I can't get enough. And if I don't build it, someone else, if I'm AT&T, if I don't build it, SBC will build it, or WorldCom, or someone else. And they weren't wrong with a 10-year time frame. But what happened was everyone built it. All this internet money came in, and Internet 1.0, there wasn't that much money to pay for all that infrastructure. And so what happened was they went from buying 100 units of equipment to buying 0 because they didn't need it. Eventually, they would buy a bunch of Cisco equipment and they'd buy a bunch of glass. But that was 2, 3, 4 years later. NVIDIA is still an equipment company. I get the software. I get the value added. My point is they're spending, and these are real numbers, right? The hyperscaler is spending $300 billion. $300 billion. By the way, NVIDIA's, that's the big four. NVIDIA's revenue, I sent this out. I think I put this on Twitter the other day. NVIDIA's revenue is, for this year, $211 billion in calendar 26. 175 billion for calendar 25. At some point, the spend by the hyperscalers will go down. The way you build buildings is you don't build a building so that you're 10% short capacity. You build a building so that you're 30% long capacity, so then you can be ahead of capacity. Inherently, then when you're that period where you're 30% long capacity, guess what you don't need to be doing? Building more building. And so what'll happen is when NVIDIA eventually faces that, their sales will stop going up, and in fact, they will go down. At the valuations the stock is right now, I would say the stock gets cut in half. Okay, at some point, it may get cut in half, 50% higher than here, but it's going to get cut in half. When that happens during that period, it's going to be very hard for the IPPs to go up a lot. Okay, it'll have nothing to do with anything happening with Vistra, Talon, etc. But their stocks aren't going to be acting like that. I mean, Nvidia's hitting a new high today. You know, just became the most valued, the most highly valued market capitalization company in the world. I'm not saying it's taking the IPPs along with it. Vistra reported blowout numbers earlier today. But my biggest risk, some point in 2025, I think NVIDIA is going to turn over, and that's going to weigh on all these stocks. It's not a fundamental thing. It's a stock thing. But remember, price equals truth. I don't sell and buy the fundamentals. I sell and buy the price of the stock.
So the one thing that I think would be kind of nutty about that outcome, the one that you're talking about, is right now the power producers are trading off of increased GPU sales because those GPUs use an enormous amount of energy. And just from what I've read, an AI related data center, one full of NVIDIA chips, uses 6 to 7 times as much power as a regular data center with just normal hard drives serving data all over the world. But even in a situation where NVIDIA demand for their chips goes down, you know, even if it goes down 50%, all of the chips that are currently in data centers, they don't cut power to those. There's not going to be
a single thing will change. Not a single number will change on any of the IPPs. And let's just be clear what I'm saying. I'm saying that when NVIDIA goes, and it will at some point in the next 3 years, goes post-growth for a year to 3 years, the stock will get cut in half. Post-growth could mean that they just, you know, like right now, let's just look at I'm going to look at NVIDIA's revenue growth, the expectations for the next couple of years. So, and by the way, they don't even need to not grow. Right now, these are the calendar year, I'll use fiscal years, okay? 106, 44, and 20. Okay. 27, by the way, the analysts have 1% calendar year growth. If they miss those numbers, I pull up EEG on Bloomberg and just look at the revisions on their revenue, it's through the freaking roof. If they miss 2 revenue numbers in a row, which they will at some point, stock's down 30%, 40%, just because this is how this works. During that period, so NVIDIA could still be growing double digits. Everything could be true what you said, but when NVIDIA goes down 30% because they missed 2 quarters, because the 20% growth ends up being 16.2% growth, in the short term, you don't want to be fully loaded to these stocks. It's going to be hard for them. You buy the hell out of them. I'd be sitting here, and maybe I will go to Talon Management and say, okay, buy a lot of stock right now, but let me tell you what's going to happen at some point. When does this start? I don't know. But you know what I'm going to do? I'm going to wait for NVIDIA's numbers to tell me when the numbers start going down. Yeah, they're going to beat numbers. They're going to beat numbers until they stop beating numbers. And that's fine. Own the stock until they stop beating numbers. Own NVIDIA stock with a 10 or 20% trailing stop, and own it. I've got this EEG chart of revenue revisions. Own it until they miss revisions twice. They miss the estimate twice, and they get the hell out.
And by the way, even if NVIDIA's sales were cut by 50%, which would be a disaster for the stock, that is still increasing demand for the power producers. It is simply demand increasing at a slower rate. This is like the GPU version of disinflation.
But what I'm doing here is I'm discussing real politics of stock prices. Yeah. Remember, we're not buying these companies. I don't have $20 billion to go out and buy Talon. Otherwise I would. We're buying the stocks. And the reality is the stocks are going to go up and down on elements of the company fundamentals, but also on the perception of the backdrop. So what's my number one risk for 2025 for these stocks? NVIDIA earnings. NVIDIA stock price. Sorry, that's
right. Their stock price. Yeah, and for clarity, what Enrique is talking about is not the fundamentals. He's talking about the stock price. You could have a situation where the fundamentals for power producers and Talon get better and the stock price goes down.
Correct.
In exactly the scenario you talked about. All right, very interesting. Anything else we should be talking about before we wrap up? Because we're getting close to the end of the hour here.
That's pretty good. I mean, look, we like the stock a lot. If anything, I'll say this from a tactical perspective. The company's going to be reporting earnings here. Reports earnings on November 14th. That's a week from today. I'm very tactically bullish into the end of January from a trading perspective. When I say that, it's because when you look at seasonality actually runs through January. People mark up their books into the end of January, not just the end of December. They actually mark them up into the end of November and then begin marking them up again in the new year. That being said, the stock just went from 160 to 200 in 4 days. So, if you don't own it, buy some, wait for consolidation and pull back. If you do own it, be patient. But ultimately, and if you don't care about any tactical stuff, which I totally understand, own this stock. It's going up 50%, in my opinion.
All right. Sounds good. Enrique Abeyta of HX Research. Phenomenal. Love all the detail. Always great talking with you in general, but specifically about this. For the people who find you as impressive as I do, how do they find you?
You can go to our website, daily.hxresearch.net. That's H is in Henry and X is in X-ray. You can follow me. I'm on all the socials at Enrique Abeyta or at HX Research on X Twitter. Again, Enrique Abeyta. I'm on LinkedIn, Facebook, all that stuff. And we also YouTube. There's a bunch of videos where we talk about Talon and a bunch of other stuff. So.
All right, Enrique, thank you so much. Really appreciate you spending the time with us today, sharing your knowledge. Everyone else who's tuned in and watched this live, we really appreciate it. Thanks for being here. And we will have this video up on YouTube and start streaming again to X and to LinkedIn later today. And Andrew will put together a bunch of shorts, so you'll be seeing this kind of content over the next week. Thanks, Enrique. Thanks, everyone else.
Thanks, everyone. Appreciate the support.